The data below paints a very clear late-cycle inflation-aware market theme. Leadership is concentrated in materials, 32%, specifically precious metals and miners, alongside healthcare, 20%, and selective financials, 13%, while traditional growth leadership is becoming more selective. The heavy presence of gold, silver, and royalty companies, combined with strong ETF exposure to GLD, SLV, and XME, signals a market positioning for persistent inflation risk, currency debasement concerns, and defensive capital preservation. At the same time, healthcare, particularly pharmaceuticals, biotech, equipment, and services, appears as the preferred defensive growth area, consistent with a late cycle to recessionary transition. The country mix, 63% US, 27% Canada, reinforces this commodity-tilted narrative as Canadian listings dominate precious metals exposure. At the stock and factor level, the theme becomes even sharper: quality and cash flow dominance over speculative beta. Strong oscillators favor durable compounders like Google, Eli, while several former momentum darlings Nvidia are show-weakening fractal and drawdown characteristics despite long-term strength, suggesting rotation rather than outright risk-off. Semiconductor exposure remains, but is more tactical, LAM research rather than broad beta. Financials favor capital markets and insurers over pure lending, while consumer exposure is selective and defensive rather than discretionary-led. Overall, this data reflects a market that is still invested, but no longer complacent, favoring inflation hedges, balance sheet strength, and late-cycle resilience over aggressive growth chasing. The market is not risk-off. It is reallocating toward inflation protection, balance sheet strength, and earnings durability.